have the current account figures coming in. Let's go cut across to Lata, who has the details. Hi, Lata.
Yes, I mean, these are dramatic numbers, but they were more or less expected by the market. As you can see, the seminal message that's coming in, for the entire quarter, the difference between imports and exports on a current basis was just $1.2 billion. That works to 0.2% of the GDP. That's as good as an account that was in balance. In fact, some people had expected a current account surplus, but this is like your inflows and your outflows were about in balance. What were the main ingredients? I think we all know the story. Exports didn't do gung-ho. They were just down, if anything, by about 1.3% compared to year-ago levels. After all, we didn't have too much of global, prosperity by way of increasing our exports. But look at the way the imports have fallen. That's down 12.3%. And there again, there's a familiar story. It's gold imports that have fallen significantly to 5.3 billion from 15.8 billion year ago. So that was a huge 10 billion fall in gold imports, and that explains how the current the trade deficit fell. Trade deficit is down to 30 billion from 45 billion. All these numbers are for the fourth quarter. The trade deficit is down. 10 billion of that 15 billion fall is accounted for by gold falling by about $10.5 billion. The remaining is accounted for largely by crude and other engineering imports. They fell largely because the economy itself had slowed down and we were beginning to pay the correct price for crude. That is the trade deficit. The trade deficit, we were in a deficit of 30 billion. How was that made up? That was made up largely because of service exports, software exports. A large part is accounted for by software. That brought in about 19 billion. The other flows come in by Indians who live abroad, what you call private transfers. That brought in about 17 billion. Private transfers also include an outflow, Indians paying out dividend, interest payments. So that took away some 6 billion. Net, we were almost in balance. There were outflows of $30 billion on account of trade deficit. There were inflows of about 30 billion because of software imports and software exports and because of Indians living abroad crediting money. So on the current account, the battle is practically entirely won. Even for the full year, if you looked at it, the total current account deficit works out to a measly $32 billion for a full year, and that's about 1.7% of the GDP. That on a capital account, actually, by current account, it's a deficit of 32 billion. On a capital account, we actually made money because there were significant inflows both on portfolio, FII flows, as well as FDI flows. So on a balance of payments basis, the total reserves of the country increased by 15.5 billion for the full year, and for the quarter itself, there was an increase of 7 billion. So on a capital account, we ended in a surplus, but current account was a minor deficit, which was more than made up by the capital account surplus, flows coming in by loans, by short-term credit taken by exporters, as well as by FDI and FII flows. Predominantly, it was FII flows which financed the difference. We've got a bunch of economists with us. Aditi Nair, the economist at ICRA, is joining in, and in a bit, Siddharth Sanyal, the chief economist of Barclays India, will also be with us. Okay, Siddharth, why not get to you first? Your first thoughts? 1.2 billion for the fourth quarter, 0.2% of GDP, on expected lines?
Yes, broadly on expected lines. I think the bigger message here is, if I see for the full year, the number is extremely healthy. The overall capital flows are comfortably covering the current account deficit. And most importantly, there was a big debate of late whether this year's number is an aberration or the previous 2 years' numbers of 78 billion and 88 billions of current account deficit numbers were an aberration.
Okay.
Incrementally, we are getting a confirmation from the numbers that most probably this is the trend which will continue going ahead also. So we are relatively on comfortable path on the current account side.
Then let me finish that argument. What is your current account deficit expectations for the current year?
Well, we are at around 50 billion now, but incrementally, if at all, the numbers might actually get revised slightly softer than going up further from there.
Okay. And of course, on a balance of payments front, it looks like capital surpluses are going to continue the way FII numbers are coming in. But let me get Aditi in on the matter. Aditi, did the 0.2% of GDP, I mean, as good as a current account balance, no deficit at all, surprise you?
Absolutely, Lata. These are very good numbers, but a confirmation of what we were expecting. We had put in our forecast at 1 to 3 billion for Q4, so 1.2 billion is at the lower end of that range. And 32 billion overall for the year is very much in line with expectations. And yes, the turnaround has been quite spectacular in terms of what we were expecting in May of 2013 versus the numbers that have now come out in May of 2014. There's been a sea change in the overall vulnerability as far as the external sector is concerned. Going ahead, I think the key sensitivities are going to be, two or three in number. One, of course, how exports are going to behave with moderate improvement in growth.
But are you expecting, how are you estimating the deficit for the current year itself?
We are looking at a baseline of $40 to $45 billion, and this is if the 2080 rule is maintained. So even though some new entities have been allowed to import gold, but the 2080 rule as of now remains intact.
So if in that the gold imports are completely freed, then you might expect a higher trade deficit, higher current account deficit.
Between 50 to 60 seems to be a more likely estimate in case gold restrictions are completely lifted.
Fair enough. I can't resist from thinking that Mr. Chidambaram would have so much wished that this number had come in before the 16th of May. He would have gloated on it. Remember when the first estimates were made by the PMEAC and by the Finance Ministry itself, it was expected that the trade deficit, current account deficit would come at 80 billion, 88 billion. They scaled it down to 75 billion. Even when Chidambaram spoke to Akanksha, our correspondent, as late as February, he was hoping that it would be below 50 billion. I mean, this is 35 billion total trade deficit, total current account deficit, 36 billion. He perhaps would have wanted to gloat and gloat over it. 32 billion. He would have really wanted to gloat over this. This is a seminal achievement. And to be fair, you have to give credit to the government for this as much as to the Reserve Bank. It was the government which, aggressively went with gold import controls and systematically raised the prices of crude. And that clearly resulted in lower imports of crude as well, or at least a more rational use of crude and of diesel in particular. Final questions to both of you. Siddharth, impact on rupee, this is largely factored in, you would say?
I would think so. This is always a backward-looking number, doesn't impact too much, but a bad number could have dented the sentiment to some extent. But as of now, this number is more or less in line overall.
Won't FIIs who are looking for an excuse to invest in India gloat over this and find this another reason to invest in India?
Well, yes, I think that is true, but at the same time, they possibly have a much bigger reason at the moment in hand, and possibly going with that particular flow. So in general, the momentum in case of rupee and in general on all most of the INR assets, we remain quite constructive going ahead.
Actually, I'm sorry, I'll have to wind up this discussion on that note. Aditi, Siddharth, thank you very much for joining us.